Hi, my name is Dr. Annette Moultrie, and this is Accounting 101. So, let's see what we will teach in this video. But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Also, click on the notification bell so you'll be notified of upcoming videos. In this video, we will begin with Chapter 2. Chapter 2 involves recording business transactions. Recording business transactions. The objectives of Chapter 2 are: explain accounts as they relate to the accounting equation and describe common accounts. 2, define what are debits, what are credits, and normal account balances using double entry accounting and T accounts. 3, record transactions in a journal and also post journal entries to the ledger. 4, prepare the trial balance and illustrate how to use the trial balance to prepare financial statements. And finally, 5, use the debt ratio to evaluate business performance. So we begin with learning objective 1. Explain accounts as how they relate to the accounting equation and describe common accounts. We know that the accounting equations is assets equal liabilities plus equity. The accounting equation is the basic tool of accounting. It is made up of 3 categories. Again, assets, liabilities, and equity. Each category contains accounts, which are detailed records of all increases and decreases that have occurred in an individual asset, liability, or equity during a specific period. An account is a detailed record of all increases and decreases. Now, we know that assets are resources that the business owns or has control of that have value. Assets are economic resources that are expected to benefit the business in the future. Now, there are many examples that were introduced in Chapter 1, such as cash, accounts receivable, equipment, building, and land. Account receivable, it represents a customer's promise to pay monies in the future for services or goods already provided. Equipment, furniture, fixtures, and land are assets used by businesses in operations. 2 new assets introduced are notes receivable and prepaid expenses. What is a notes receivable? Well, a notes receivable is a written promise by a customer to pay a fixed amount of money along with the interest on a specific date. So generally, a notes receivable requires a formal promissory note that includes a stated interest rate. Prepaid expenses are expenses paid in advance that are expected to benefit the business in the future. Examples of prepaid expenses are your prepaid rent, prepaid insurance, and office supplies. Land, of course, is the cost of land a business used in the operation. Building, the cost of an office building, a store, or a warehouse. And then you have your equipment, furniture, and fixtures. A liability is a debt. It's a debt that something that the business owes. A business generally has fewer liabilities than asset accounts. A payable involves a future payment of cash. A notes payable is a written promise made by the business to pay a debt, usually involving interest in the future. Another liability account is the accrued liability. It is the amount owed for goods or services provided, but not yet paid by the business. Unearned revenue is another liability account, which occurs when a company receives cash from a customer before the business provides the goods or services. Here in Exhibit 2.3, you have your equity account or equity accounts. So the owner's claim to the assets of the business is called equity or owner's equity. A company has separate accounts for each element of equity. So some examples of equity accounts are, of course, the owner, the capital, the withdrawals, revenues, and expenses. Here in Exhibit 2.4, it shows the chart of accounts for Smart Touch Learning. A chart of accounts is used to organize a company's accounts. It lists all the company's accounts along with the account numbers. The account numbers are just shorthand versions of the account names. Each account has an individual account number, similar to how Social Security numbers are unique to each one of us. Now, the chart of account varies from business to business, though most account names are common to all companies. Now, companies need a way to show all of the increases and all of the decreases in each account, along with their balances. So that's where a ledger comes in place. So a ledger is used to complete this task. So what is a ledger? A ledger is a collection of all accounts, the changes in those accounts, and their balances. A ledger provides more detail than a chart of accounts. This is the end of Learning Objective 1. We will begin with Learning Objective 2. So Learning Objective 2, we will define debits, credits, and normal account balances using double entry accounting and T accounts. So what is a double entry accounting? In accounting, the double entry system is used to record the dual effects of every transaction. Okay? A transaction would be incomplete if only one side of the transaction were recorded. So in addition, recording only one side of the transaction, it leaves the accounting equation out of balance. So always remember, the accounting equation has to balance. It is assets equal liability plus owner's equity. A T account is a shortened form of the ledger and is called a T account because it resembles the capital T. The name of the account is listed on top of the T. As you see here in this example, you have the T. And the name of the account is cash. The left and the right side of the T account are used to record increases and decreases in the account. So you have your debit, it's abbreviated as DR, and then you have your credit, which is abbreviated as CR. Increases and decreases to an account are determined by the type of account: assets, liabilities, or equity. Now, depending on the type of account, increases are recorded on one side and decreases are recorded on the opposite side. Assets are always increased with a debit and decreased with a credit. Liabilities and equity are always increased with a credit and decreased with a debit. Now, debits are not always increases or always decreases, and neither are credits. The debit or credit designates on which side of the T account the transaction is recorded. And here you see with the equity is increases with a credit and it decreases with a debit. If a business wanted to record an increase of $30,000 to the cash account, it would debit to cash. They would record a debit to cash of $30,000 if they wanted to increase the cash account. Okay? If the business instead wanted to record a decrease of $20,000 to the cash account, it would record a credit of $20,000. So to increase cash, which is an asset account, to increase it, you would debit. To decrease it, you would credit. Notice here in the expanded accounting equation that the owner withdrawals and expenses record increases and decreases opposite of the owner's capital and revenues. Now, this is because increases in owner withdrawals and expenses decreases equity. Let me say that again. Withdrawals and expenses record increases and decreases opposite of owner capital and revenues. Okay? Again, this is because increases in owner withdrawals and expenses decreases equity. All accounts have a normal balance. All accounts have a normal balance. An account's normal balance is on the side of the account that increases the account. Assets are increased with a debit, so the normal balance is a debit. Liabilities are increased with a credit, so the normal balance is a credit. Expenses and owner withdrawals are equity accounts that have normal debit balances, unlike the other equity accounts. They have debit balances because they decrease equity. So owner, capital, and revenues have a normal balance of credit. Here you see in Exhibit 2.5, it summarizes the normal balance of each type of account. This table also shows assets, expenses, and owner withdrawals are all increased with debits and have a normal debit balance. Here you see your liabilities, your revenues, and owner. They have a normal credit balance. So assets, expenses, and owner withdrawals, they have a debit normal balance, whereas liabilities, revenues, and owner capital, they have a credit normal balance. An easy way to remember the rules of debits and credits is to memorize this helpful sentence. All elephants will love rowdy children. All elephants will love rowdy children. The first 3 words in the sentence will help you remember that assets, expenses, and withdrawals all have normal debit balance. The last 3 words in the sentence will remind you that liabilities, revenues, and capital all have normal credit balances. The T account is used to obtain a summary or balance of a particular account. The summarization of the account is reported on the side of the T account with the larger number. For example, if the total debit for cash equals $35,500 and the credits are $23,200, the normal balance is $12,300. The total of the credits is subtracted from the total debits to determine the ending balance. So you have your $35,500 on the debit side, and then you have your $23,200 on the credit side. So when you subtract these two, it will give you the balance of $12,300, which is the ending balance of the cash of this particular cash account. Thank you for watching. And please, if you haven't already, please click the subscribe button below.